or not, if you look historically, long-term rates like the 10-year mortgage-backed securities, which is where 30-year mortgage rates come from,
Right.
they actually move lower. And this is counterintuitive to what many people believe. And I'm going to explain to you why. And it has to do with really the main influencer of mortgage rates, which is inflation. So let me give you an example of why inflation is so important for mortgage rates. So Phil, let's say I needed to borrow $100,000. And I said, Phil, will you lend it to me? And you might say, you know what, Dan? Okay, I'll lend it to you, but I'm going to charge you a certain interest rate, of course, right? So you charge me an interest rate, and the fixed payment that you receive over the next 30 years, the interest is $500 a month. So you go to the store, you have a list of goods that you want to go purchase. And the first month you can go ahead and you can buy everything. The $500 gets you all the items on that list. And maybe for a few months that remains the same. But inflation is rising at a rapid pace like we're seeing in the economy today. Well, a few months down the road, you go to the store and now you can't buy everything on that list. What's happened? The price of goods and services has gone up. It has literally eroded the buying power of your fixed return that you have. So this is the impact that inflation can have. Now, listen, we and you, we have a deal together. This is in place for 30 years. You can't do anything about my loan. But let's say John comes to you and says, hey, Phil, can I borrow $100,000? You might say, okay, but what are you going to do? You're going to charge him a higher interest rate to provide you with a higher level of interest to start at a higher perch, which will combat that rising or rapid pace of inflation. So when you see inflation moving up in the market, it's one of the main drivers of interest rates. You typically see interest rates move higher. When inflation comes down, interest rates can come down. So this is like the most important aspect of what's going to be impacting rates. As I mentioned, inflation right now is red hot. And the Fed, when they hike rates, what happens is they actually curb inflation. So when the Fed hikes the Fed funds rate, again, they're not hiking mortgage rates, but what they're doing is they're doing this to curb inflation. And as inflation gets in check, you actually see long-term rates come down. So it's counterintuitive, but that's the main component there. Now, the other thing is that the Fed, as I told you, has a balance sheet of $9 trillion. Now, they've been reducing their purchases. They're still adding to that balance sheet currently, but come March, they're going to be done with their outright purchases. But here's something that they don't really tell you very transparently. The Fed, remember what they're holding on their balance sheet. They're holding bonds and treasuries. And these are all things that some of them mature, or when they receive principal payments, when they receive payoffs, whether it's a refinance or a sale, they get that money. And normally these things would fall off their balance sheet. But what they've been doing is taking all of that money and reinvesting it back into mortgage-backed securities and treasuries.